Hi, welcome to another episode of Talking Tax with Alex. My voice is a little raspy. I'm just recovering from an illness, so I have a little bit late on this video as well, so please bear with me. This is part 2 of the court case analysis that we were just doing on our last episode. So on this agenda today is we're going to talk about the ruling and my closing thoughts. The introduction, the facts, and the issues of the case will be in part 1. They'll be linked above, and I'll put a link in the description as well. So, like I previously mentioned, this is part 2 of our court case analysis for charitable contributions of vehicles. It's an interesting case involving a taxpayer who is trying to we're going to go to the facts real quick. I'm going to run through this quickly because we already covered this in part 1, but the taxpayer is trying to donate the 50% partial use of a plane to a charity, and they filed, this is for the 2009-2010 tax year, and yeah, they're basically trying to cover their tax liability with a charitable donation, a 50% interest. The issues, again, I'm going to kind of gloss over these quickly because these are all in part 1. But the biggest issues the core issue is whether the charitable deduction is allowed, given the facts and the circumstances and the documentation provided. And so on to the ruling. And really the ruling hinged on what does contemporaneous written acknowledgement count, or when does it count? What is contemporaneous written acknowledgement as it is stated in the tax code? So the ruling went against the taxpayer, and the tax appeals, or the appellate court affirmed the lower tax court's original ruling. So this really puts a strong case for the government. And sets a very strong precedent. In the way that tax court works is, if you get into tax court and the tax court rules, you know, the IRS has a precedent to go off of, and they can go after similar cases that are in these fact patterns and have something to kind of use as guidance. When you have an appellate court affirm what the tax court ruled, then the IRS has an extremely strong case given these facts and circumstances. So any kind of contributions that are kind of related to this, now we have a very, very strong fact pattern, and we will know how the courts are going to rule, what the IRS's position are going to be when it comes to donating a vehicle. In this case, it was a plane, but you know, there's other vehicles you can donate. You know, classic cars, regular cars, not a 50% ownership of a vehicle, but an actual airplane. I guess helicopters. I don't know, boats. You can donate a lot of vehicles. So part of the ruling and part of this case was that the CWA, so that's an acronym for contemporaneous written acknowledgement. So CWAs for vehicles are a lot more stringent. And this ruling was the deduction was ruled as disallowed by a matter of law. What was the law? Well, the statutory requirements of CWA were not met. And so we did kind of go over the statutory requirements previously, but in a nutshell, you need to provide certain documentation that is provided within 30 days. It has the charity's name and signature, it has your name and signature, has your taxpayer ID, so your social security number, and it needs to, for vehicles, you need to also include what the intended use of the vehicle is for the charity. Are they going to, showcase it? If it's a classic car, are you just to turn around and sell it? That all needs to be documented and reported. Something interesting also that kind of came out of this case was the taxpayer requested a read together request for their documents. So they submitted a bunch of different documents. Let's see if we can go to the issues here. So they submitted a bunch of different documents, and some of the things that were missing that were important are the 1098C. So that's like 1098, maybe you heard of that for mortgage interest or whatever. But 1098C is actually what you issue or what a charity issues to you when you donate a vehicle. That's acknowledgement of that receipt. Form 8283, which was signed and missing, the social security number was also missing. And so taxpayer provided other things. They provided an agreement between the charity and themselves. And basically the taxpayer said, or they requested the courts to read all the documents as if they are one. And if one document was missing a social security number, but it had his name, one document was missing a name, but had the charity's signature and all that stuff, taxpayer was saying, hey, I provided kind of everything. Can we just count it all together? And the court said no. Everything needs to be in accordance with the law. And, the law is not that strict. I mean, you just have to have your name on it. And the fact that this taxpayer was trying to submit stuff that didn't even have his name on it, kind of speaks volumes of the level of organization this taxpayer was, and it kind of showcases the strength of his case, which is not very good. In my opinion, it was very weak. The other thing I thought was very interesting that the court brought up, and the taxpayer argued the doctrine of substantial compliance. And the taxpayer said, hey, I mostly complied with everything. Can you just take it all together and kind of help me out? And honestly, it's interesting in my opinion because substantial completion and substantial, materially correct in the accounting world and the tax world, this actually is a thing. Substantial compliance, if you so certain rules and regulations in the tax world get very complicated, and if you substantially comply with something and you get it, 80% there, then the IRS and most government agencies will actually be more accepting of it. You made a good faith effort to comply with the rules and regulations, and substantial compliance would apply here. But the courts basically said it doesn't apply to substantial compliance. Does not apply to strict, basically the strict substantiation requirements of the tax code itself. For example, if you didn't put your name or your social security number, you can't substantially comply to that. You either do it or you don't. And kind of just picking apart the ruling a little bit more and to give you a flavor for the aircraft donation agreement as a deed of gift, which a deed of gift is allowable if it meets the CWA requirements. But what was the one that was presented to the court was it wasn't contemporaneous. It was actually provided many years after the fact of the donation, so it wasn't within about 30 days or so. And for people that are donating, like you go to Goodwill and donate clothes, you usually get that little receipt that says, hey, I donated clothes. That is contemporaneous written acknowledgement. You donated the clothes and you got acknowledgement from the charity. This case, this donation agreement, I think, was dated many years. I don't know. I think it was dated when the amended return was filed, not when the original return was filed or something. It was just not contemporaneous. It was missing the donor signatures. It only had the charity signature. So not only did this agreement not have, it was just missing signatures. So like the CWA requires signatures, requires names and dates. It wasn't dated before the year end. So this is kind of this is related to the not contemporaneous. The document was dated after it was supposed to. It was missing the taxpayer's social security number. So you kind of see in a pattern here, right? This document that they provided didn't even meet the bare minimum of what the statute says is allowable that would allow you to take a charitable deduction. And then finally, it was missing the charity's certification of intended use and duration. And this is the charity saying what they're going to use in this case, 50% ownership interest in the airplane. What are they going to do? So here are my closing thoughts. I thought the substantial compliance doctrine is actually a very interesting thing that came up in this case. It's and it's good to know. And if you don't know, now you know. If you're watching this video, now you know. Substantial compliance really is a thing. And in the tax world, you don't need to strictly comply with everything. If it's governed by regulations and rev procs and it gets really complicated, obviously you do. And what this allows for is basically user error in compliance. And if you're able to show in good faith that you complied with the rules and regulations, then the IRS you can argue this. You can argue this in front of the court, like, hey, I tried really hard. These rules and regulations are complicated, or we got 9 out of the 10 rules correct on the pronouncement. We took a position on this one. There's wiggle room. And so I thought it was interesting that it came up in this case because where the line is drawn, and I learned in doing this case, where the line is drawn is actually substantial compliance just doesn't apply to the statute itself. So basic stuff, name, social security number, required forms that have to get filed. Like if it's spelled out in the code, you just do it. And I learned that today, or I learned that doing this video. I think it's very important to keep your charitable donation receipts. Obviously, being in the tax world, knowing that importance of documentation, I think you just need to do it. Charitable deductions are a very popular planning technique. I see this a lot in my practice. It is something that a lot of people should consider, especially if you have assets or have wealth and you want to mitigate your tax bill. And I guess in my practice, I see it a lot, and it gets really complicated the more extravagant you want to go. But it also becomes very rewarding in that you get to choose where your assets go, and it's kind of like a where would you rather your money go? It goes to the government or it goes to the charity of your choice. So a lot of people like to choose the latter, the charity of their choice, and in doing so, then you get a tax deduction. There's also some other cute tax maneuvers that you can do. I'm not going to cover it in this video, but if there's interest, I can talk about something. Small stuff like donation of appreciated stock or something like that. And finally, I think if you're considering charitable donations, please consult your tax advisor. This area does get a little complicated, requires some additional rules and following additional rules and making sure you're compliant. So that's it for this episode of part 2 of if you like this kind of content, please like the video, subscribe to the channel, and comment or email me your thoughts, or you can comment and email me topics that you'd want me to cover as well. That's it. All right. See you on the next video. Bye-bye.